Welcome to the weekly markets update. I'm Marita Garishvili, investment consultant at Kamak Retirement Group. Today, we're recapping what moved the markets during the week from August 10th to August 14th. After pushing to record highs, stock price gains faded by the week's end as the market gave up hope that Congress could resolve its differences on the next coronavirus stimulus bill anytime soon. The S&P 500 ended the week up 0.7%, just modestly below its all-time high. U.S. Treasury yields climbed this week as the Treasury Department issued new 3, 10, and 30-year bonds to finance the government's aggressive spending measures to fight the coronavirus pandemic. The increased supply helped push Treasury yields to a 5-week high, with the 10-year Treasury yield rising to 0.71%. The Federal Reserve's unprecedented support for the bond market has seen a rush of investors pile into a riskier corporate debt in the aftermath of coronavirus pandemic. As the Treasury yields collapse, corporations are rushing to issue debt to raise liquidity and take advantage of the lower borrowing costs while the investor appetite is strong. The mortgage giants Fannie Mae and Freddie Mac instituted a new adverse market fee of 0.5% to most mortgage refinances starting on September 1st. The move is intended to offset some of the higher costs associated with COVID-19 related economic and market uncertainty. The Mortgage Banking Association strongly opposes the fee, which will likely be passed directly onto consumers trying to take advantage of the record low borrowing rates. After negotiations between House Democrats and Senate Republicans collapsed last week, the timeline for the next coronavirus stimulus package is still unclear. Over the weekend, President Trump announced a series of executive orders to provide temporary relief. The hope is that executive actions will spur lawmakers to come up with an agreement, but the near-term resolution doesn't seem very likely. Weekly initial jobless claims filings fell below 1 million for the first time since the pandemic began in March. The total people claiming benefits from all programs, which include the Emergency Federal Pandemic Unemployment Assistance, fell to 28.3 million, a decrease of 3.1 million from a week ago. The better-than-expected data suggests the economic recovery could be gaining traction. The Consumer Price Index increased 0.6% in July, up by 1% on an annualized basis. The surge in gas prices accounted a significant portion of the monthly increase. The core inflation measure, which excludes food and energy prices, was also up 0.6% in July, its largest monthly increase since January of 1991. On a year-over-year basis, core inflation is running at 1.6%. The stronger-than-expected inflation numbers pushed Treasury yields higher and steepened the yield curve. The monthly retail sales report came in weaker than expected, only rising by 1.2% in July. While the consumer is still spending, the monthly increase is lower than the sharp rebound seen in the previous retail sales reports. The mix of spending continues to be concentrated in online sales and groceries, with restaurants and department stores still lagging. Small businesses have not been immune to the disastrous economic situation unleashed by the coronavirus pandemic. While the media reports have highlighted the surge in large company bankruptcy filings this year, there's no real-time data that captures the impact on small businesses. The best metric available is produced by online review website Yelp. Yelp is reporting that more than 80,000 small businesses across America shattered since the beginning of March, with the restaurant industry being hardest hit. This is particularly troubling since small businesses employ nearly half of American workers. Thank you for watching. For more questions, please visit our website, kamakretirement.com.